Welcome to the Candlestick Forum Inverted Hammer Signal Training Program. My name is Steve Bigelow. I've got over 35 years of investment experience with approximately 25 years oriented toward the candlestick analysis area. I've written 3 books on candlestick trading. The first book kind of getting people oriented toward the thinking of candlesticks. The second book showing the high profit patterns and signals that work most of the time. And the third book telling you how to eliminate your emotions by using the high probability aspects of candlestick analysis. But through the years, I discovered out of the universe of candlestick signals, of approximately 50 or 60 signals, there's only 12 signals that you really need to learn. And once you learn those signals, you will probably be able to identify 99.99% of all market trend changes. And if you understand the psychology that created those signals, you have a pretty firm grasp of what makes prices move up or down when they do. So today's training is going to be for the inverted hammer, which is usually the first evidence that buyers are starting to step into a downtrend. The inverted hammer is a signal that's formed when it opens low, and then after an extended downtrend, the bull will start stepping into the previous day's trading, or at least shows there's some buying after the open in the downtrend. This starts concerning the bears. It is quite often found, especially when you're in the oversold area of stochastics. My stochastics for these illustrations are slow stochastics 1233. Also, the other indicators we have on our charts is this dark red line is the 200-day moving average. The blue line is the 50-day moving average. The gray line is the 20-day moving average. These are all simple moving averages, and the reason we have them on our charts is because every major money manager around the world uses these moving averages to make decisions about their portfolio. The advantage as a candlestick investor is that we can see exactly what's going on in investor sentiment right at those important decision-making levels. The most important market or trend line we have on here is the 8 exponential moving average, this black line. We call this the T-line, and it has a very simple concept that if you see a candlestick buy signal and a close above the T-line, the probabilities of remaining in an uptrend are pretty strong until you see a candlestick sell signal and a close below the T-line. One caveat to that is the further away you move from the T-line, the higher the probability you're going to come back to test it. So the inverted hammer signal is evidence that after an extended downtrend, the bulls are starting to step in. This makes the bears nervous, but by the end of the day, they close it back down toward the lower end of the trading range. Now, the formula that you have to know in candlestick analysis is the number 2. Like the hanging man, shooting star, and hammer signal, the shadow on the inverted hammer should be at least 2 times greater than the body. And the body can either be white or dark. It doesn't matter, because this was the important information, that the bulls had stepped in, but by the end of the day, they'd close back down here at the lower end of the trading range. But what happens next is important. If the bulls open up positive the next day, the bears say, shoot, the bulls are back here again. Get me out of this trade. It makes them too nervous to stay in it, and that's what starts the uptrend. In this illustration, as we can see, there's a small shadow to the downside. That's not relevant. What's relevant is the fact that they took it up and brought it back down, gave the bears some relief, but the next day when they opened it positive and started taking it back up, the bears saying, shoot, get me out of the way, and that will start a strong uptrend from that point. As we can see in this illustration, the ultimate ultimate inverted hammer is the gravestone doji, where they open it right near the bottom, take it up, and close it right back down where they opened it right near the bottom. And as you'll note in this one, once they have confirmed the buyers, which was in this case where they closed it back up above the T-line and closed it right here at the same level as this downtrending channel, the next day when they gap it up, that tells you exactly what you want to know. That not only has there been a change of investor sentiment, but the investor sentiment now has gotten so enthusiastic that there's probably going to be a strong uptrend after that. This gap up after a candlestick signal, in the case of any candlestick signal, is very important. It tells you that they've changed investor sentiment and they're very enthusiastic to get back into that trend, which is exactly where we want to be as a candlestick investor, is in an uptrend coming out of an oversold condition after a buy signal, telling us the enthusiasm is coming back into that trend quite heavily. It acts like a little warning flag. As we can see, the bulls were participating in this market that day and then brought it back down, relieving the bears. But the next day when they open up positive, that's a good indication that you're now in a strong uptrend. Now they've reconcerned the bears. The appearance of an inverted hammer is merely evidence that the bulls are starting to come back up into the seller's domain, and the sellers don't like that. Again, followed by a positive candle the next day is that indication to the bears that the bulls are picking up strength. They want to be out of the way and covering their short positions. And like all candlestick signals, the inverted hammer has the same criteria as far as a stop loss. I've mentioned this in some of the other trainings, that in 35 years, I've often heard professional money managers tell you that you want to cut your losses short and let your profits run, but I've never heard a single one of them tell you how you cut your losses short and let your profits run. And the inverted hammer is very simple. If it opens positive the next day, what's that tell us? That tells us with a high degree of probability we're in an uptrend, which also tells us that we shouldn't see any trading back down below the low of the inverted hammer, because that would tell us the bears are still there. That's where you put your stop. You don't want to see them trade it back down through that level. If they do, close out the position. The signal didn't work. And anytime you see a bottoming action, stochastics in the oversold area, we've got inverted hammer, inverted hammer, inverted hammer, but none of them are confirming. Now we have a bullish engulfing signal, a little doji spinning top, inverted hammer. Now we have bullish confirmation. So sometimes you have to be patient and wait for those signals to confirm, and it wasn't until the end of this indecisive trading range that it finally confirmed with the bulls stepping in and closing above the T-line. As mentioned before, the evidence of the bulls stepping in and closing back lower, it doesn't matter whether the head of that inverted hammer is a bullish white head or a dark. The important factor is the trading range back up into the previous day's trading that got the bears nervous. And another reason the stop loss is so important, that if it opens positive it should be trading positive, is because in the inverted hammer signal, unlike some of the other signals, the probabilities that if it opens positive after an inverted hammer, especially down in the oversold area, that if it opens positive the next day, the probabilities are extremely strong that you're in an uptrend. How strong is that uptrend going to be? We don't know that. We just know we would be in an uptrend. But the probabilities of being in that uptrend is probably much more, persistent, much more accurate than some of the other signals. The other signals are relatively accurate, but the inverted hammer probably has somewhere above a 90 to 95% probability that you're going to be in a nice uptrend. And good confirmation is a gap up from the previous inverted hammer signal. Comes back to that very simple logic or very simple analysis that if you see an inverted hammer, which is an indication there's a change of investor sentiment, and they gap it up the next day, that tells you exactly the magnitude or the force of which they want to get back into this trade and should start a big, strong uptrend. Witnessing an inverted hammer, especially in the oversold area, just gives you a strong probability that you've seen a reversal. Also, use the other techniques that we've learned in candlestick analysis that the Japanese rice traders have provided for us. Is where do most people sell? They usually panic sell at the bottom, which means if you see a gap down in an oversold area, start watching for a candlestick buy signal. What type of signal will it be? That we have no idea. But at the end of the day, we should be able to identify whether the bulls are starting to take control after the gap down. A gap down in the oversold area, start watching for some sort of sell signal, or some sort of buy signal. Oversold area, again, stochastics of 1233, below 20 means it's an oversold area. If you start seeing gap downs in an oversold area, that's usually the panic selling. This used to be the problem for most investors without candlestick signals, is where do you grab for that fallen knife? Candlestick signals make it very simple. If you see a candlestick reversal signal, get ready to be buying, especially if the buying opens positive the next day. That's confirming that this reversal signal has been telling you that the trend has changed. There are candlestick signals that allow an investor to get ready for the next price move. For example, the flutter kicker is a signal that tells a investor that a potential kicker signal is setting up because it has a doji in the middle. The inverted hammer acts the same way. It allows the investor, candlestick investor, to be prepared that if it opens positive after an inverted hammer, you want it to be buying right away. So you could be setting up your trade situation or your trading strategy for the next day based upon the witnessing of a inverted hammer, and then just seeing it open positive the next day or trading positive the next day. And as with all candlestick signals, the more criteria you can put together to make sure that you're in a positive trade, the higher the probabilities you're going to make money. For example, notice the inverted hammers occurring right here on the 200-day moving average. And right about the same level, you just had another little bullish type signal bouncing up off the 200-day moving average. Notice what we have here. We have an inverted hammer type signal confirmed. Notice what we have here. We don't have a candlestick reversal signal. Some people will say that should be a piercing signal. But remember, a piercing signal has to open below any of the previous trading. So this is just an up day and a downtrend bouncing off the 200-day moving average. One of the results of an uptrend bounce is that it doesn't go very far. It's a bounce. It's not until you see a candlestick reversal signal that you usually get the strong price trends. Part of the candlestick analysis is where is the signal occurring. Once again, there's that non-signal signal. Told us there was a bounce. Then it came back and we did a doji, an inverted hammer. Then the inverted hammer is confirmed with a bullish trade. Right at the same level they bounced it before. So this one we can conclude was not a reversal. It was just a bounce. This one we can conclude is a reversal at the same level that it started bottoming out before, or giving us a double bottom. And we know kind of the factors of a double bottom. That basically tells us the bears are happy, the bears are happy, the bears are happy. Then all of a sudden there's a bounce and they're worried. But they pull it back and the bears are happy again. But then at the same level it bounced before, the bulls step in, the bears say, shoot, the bulls are back here again, get me out of the way, and that usually starts the second big uptrend. And looking for a reversal is sometimes observing the obvious. An inverted hammer, why did it occur here? Well, look where the doji hammer type signal occurred over here. Right at the same level it bottomed out before, they're bottoming it out again. Makes the probabilities of being in the correct trade at the correct time that much greater. Again, observing the obvious. An inverted hammer right smack dab on the 50-day moving average. If you're an institutional buyer and you like this stock and it moved up and started backing away or backing back down, where do you think you're going to want to be watching to buy? You want to see if it's going to support on a major support level. We see that instantly starting the uptrend. And like most candlestick signals, the bigger the signal, the higher the probability there's been a change of investor sentiment. As illustrated in this chart, notice how big the inverted hammer was. The bears are really worried, but finally relieved when they brought it back down. But then they started to back up the next couple of days, closing above the T-line, gapping it up, starting the uptrend, pull back again, kind of an inverted hammer, doji, left-right combo, followed by a gap up, starting the next leg up. Another inverted hammer. Notice how far it came up into the previous day's trading. It came all the way up through the open, tested the high of the previous day, came back down again, relieving the bears. Next day they open up positive. The bears say, shoot, the bulls are back here, get me out of the way. These will usually start a fairly strong uptrend. And where do most people sell? They panic sell at the bottom. Notice how they gapped it down, tried to bring it back up, took it back down, inverted hammer type signal in the oversold area. What do we want to see the next day? We want to see if the bulls are coming in. Inverted hammer type signal, inverted hammer. Notice how the trading got up most of the way into the previous dark candle. That had the bears nervous. Then when they gap it up again, makes this a very strong, compelling reason to start getting into this trade. The bigger the signal, the higher the probability there's been a change of investor sentiment. First criteria or first target on this one would be if they open up positive, they're going to come back up and test the high of that level. If they go through, obviously they're going to the next resistance level. Like all candlestick signals, confirmation is a very important aspect of whether the bulls are starting to take control. What do we want to see after an inverted hammer signal in the oversold area? We want to see that the bulls have stepped in. Good confirmation is not only positive trading, but a gap up from the previous day inverted hammer. Once again, that tells us not only are they have a change of investor sentiment, but they're very anxious to get back into this trade. Meaning the bulls are very anxious to get back into this trade. And what factors can we put into our analysis of whether a reversal is going to occur? Note how we're in a downtrend, 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 starting to move away from the T-line. They gap it down. Anytime you see a gap down in an oversold condition, start watching for a reversal signal. If it's an inverted hammer signal, then start watching for a positive open the next day. The more they gap it up, the higher the probability they're going to be not only reversing the signal, but having a very strong price move in the new direction. Inverted hammer, oversold, end of a strong downtrend, moving away from the T-line, and they gap it up the next day, you want to be a buyer. This would have been a scary day. It would have probably told you to give it one more day. If it didn't open positive, which in this case they gapped it right back up, it would have told you if they open it lower, get out of the trade immediately, because that meant the downtrending T-line was still acting as a resistance level. But the reason you want to give it one more day is because of all the other elements of where you are. You're in the oversold area, inverted hammer, gap up, close above the T-line. Has all the elements of a reversal. So if this is still profit taking from this downtrend, give it one more day. But we know it has to open positive and trade positive to stay in that position. So good confirmation is, after seeing a gap down in an oversold area, a bullish inverted hammer signal, followed by a gap up the next day that closes right above the 50 and right at the T-line. This should make a good buy and gives you a good criteria for the next day. They should be trading higher above the T-line. Inverted hammer, remember, a gap up shows new power coming into the trend. It might not go straight up, but the fact that you see in buying and strength coming in after that buy signal, any little pullback better be decisive versus indecisive. And if this positive trading after an inverted hammer also creates another pattern, such as a little scoop pattern, that gives you that much more credibility that this uptrend is going to be in progress. Here is a good example of why you need to see bullish confirmation. Kind of an inverted hammer right here. What do we need to see? We need to see it open positive and trade positive. It didn't. You're not in that position. Down here, once again, back in the oversold area, inverted hammer trading positive. That was what caused the next uptrend. Does the next day have to close above the T-line? No. Remember, the first criteria for any reversal is the signal. The T-line is a confirmation indicator. Once it comes up to the T-line, now we start watching to see if the T-line is going to act as resistance. In this case, notice all the criteria that we have going for us. It's a good distance away from the T-line. A inverted hammer, gravestone doji, stochastics in the oversold area, good distance away from the T-line, and they gap it up to it. There's a good probability they're going to go through up to the next resistance level. Inverted hammer, oversold area, a good distance away from the T-line. They gap it up the next day. Start watching for more bullish trading. Inverted hammer, away from the T-line, gap up. That combination tells you there's still a lot more upside. This is not rocket science. This is merely the observations that the Japanese rice traders have made for over the last 400 years. The reason we're looking at candlestick signals today is because there's one basic premise that makes it consistent, working for centuries, and probably will work for the next 4 centuries, is that we're basically looking at the graphic depiction of human emotions. Human emotions work the same way in the same similar trend areas as they have for the past 400 years. The Japanese rice traders were just able to identify it and put into a graphic depiction that allows us to identify those same patterns or those same signals over and over. There are some things in candlestick analysis that you do almost on an automatic basis. For example, if we see a kicker signal up in the overbought condition and they gap it down below the previous day's open, we know to immediately close out that position. Inverted hammer in an oversold condition and they gap it up the next day, that should be an automatic. You should be buying immediately. The bigger the confirmation of an inverted hammer, the higher the probability the change of investor sentiment has been put in place. Understanding what each signal should do allows the candlestick investor to be in a correct trade with a much greater degree of probability. For example, inverted hammer, what do we want to see the next day? A bullish confirmation. The bullish confirmation in this case was a doji right back on the T-line. That was confirmation for the inverted hammer. Did it change the trend? Well, we know the simple rule of a doji. It's going to move in the direction how they open it after a doji. In this case, when they opened up positive, that told us we were going positive, number one. Number two, told us that they were trading up above the T-line, that we were probably still going to move higher. So does a inverted hammer gap up always guarantee a very strong price trend? Not always, but the probabilities are so high that you are going to be in an uptrend. To try to go against those probabilities are going to be detrimental to your account. The reason we are looking at these signals is because they work. The first rule of thumb on Wall Street is if something doesn't work, it's gone immediately. Japanese rice trading has been around for 400 years. The Japanese candlesticks have been around for 400 years. If they didn't work, we wouldn't be looking at them today. The problem, not the problem, but the solution for using candlestick signals correctly is learning how to use them. The reason they have been actively used in the United States isn't because they were hidden, it's just nobody ever paid attention to them. And so when they were introduced into the United States about 25 years ago, people started using them because they do work. There is a high probability factor to these signals. Inverted hammer, gap up through the T-line. Should be heading higher. The reason they work, as I just mentioned on the previous screen, was that the Japanese rice traders, the Hamna family that used these, did not become wealthy using them. They became legendarily wealthy using candlestick signals because they were using one simple premise that is always there in the markets, and that's human emotions. Inverted hammer, not confirm the next day. Inverted hammer, confirm the next day. Candlestick analysis provides very simple rules to keep you out of bad trades and get you into good trades. And it's mostly on how they open after a candlestick reversal signal. As illustrated in our training on the doji, our best friend is a doji followed by a gap up, especially coming out of an oversold condition. The probabilities are extremely high that not only are you going to have a profitable trade, but you're going to have a strong profitable trade. Same scenario with the inverted hammer. Inverted hammer almost looks like a gravestone doji followed by a gap up is your best friend. You should have a very strong price move after that. Once again, the probabilities of a positive open after an inverted hammer of producing a profitable trade is extremely strong. 90, 95% or even greater, which makes it very simple for your stop loss. If it opens up here, it shouldn't come back down below the low of that inverted hammer. Another factor for making a reversal signal much stronger is the combination of other signal descriptions and or other indicators used in combination with that signal makes for a higher probability that a reversal has occurred. For example, as we've seen demonstrated already, that if we see a gap down in an oversold condition, that tells you we're probably at the bottom. We're looking for a candlestick reversal signal. Next day we see an inverted hammer. That tells you there's a good possibility a trend change is about to occur. And if they open up positive that next day, that's further confirmation that there's been a trend change. So if we're buying right here, we know that we've got more upside. Or in this case where we see an inverted hammer Harami, where it opened and closed inside the previous day's trading, was another indication that the selling had stopped, and if they opened up positive after an inverted hammer type signal, the new trend was about ready to start. A gap down in an oversold area, big selling in the oversold area. So a gap down and big selling, what does that reveal? It reveals that panic selling in the oversold area. What do we want to start watching for? We want to start watching for some sort of reversal signal. If it's an inverted hammer signal, especially in the stochastics in the oversold area, we know the probabilities are extremely strong that if they open up positive the next day, this was all indications that we were near a bottom. Or we witness a inverted hammer Harami, the selling has stopped, a big bullish candle, or this whole system right here is called a Morningstar signal, especially when it occurs in the oversold area, followed by a gap up, followed by a close above the T-line. All indications that now there's going to be some more upside. In this case, it wasn't a lot of upside, but this would have been a good trade on a positive open and closing out up in here somewhere. If we see an inverted hammer occurring right on a major support level, just observe the obvious. The obvious is that's where everybody started buying again on the support level, started a very strong uptrend at that point. Here's a case where the inverted hammer was actually the gap down itself. Downtrend, downtrend, gap down, and immediately started trading up, but came back down and closed as a gravestone doji, the ultimate of inverted hammer signals. The following day they opened positive. That was the time to be buying. Where was our stop loss? Wouldn't want to see it trade at all back below the low of this candle. An inverted hammer, kind of a little kicker type signal, Morningstar type signal, stochastics in the oversold area, all the indications there's been a change of investor sentiment. Look for more upside. The inverted hammer is just an obvious sign that the bulls have stepped in. They're pulled back at the end of the day, but when they come back in again the second time, that tells you they're moving positive. An inverted hammer gapping down in the oversold condition, look for bullish confirmation the next day. Very easy to identify. And note in this chart how the inverted hammer doji is the middle indecisive trading day for a Morningstar signal. But there was added information that they tried to take it up during the day and brought it back. So there was a double confirmation here that you had an inverted hammer doji, followed by a gap up, followed by a close above the halfway point, creating a Morningstar signal. Just added information that the bulls were starting to take control. And a reminder that all candlestick signals don't work solitarily. Inverted hammer, doji, spinning top, and then a gap up. So there was a whole combination of indecisive trading down here, starting with the inverted hammer type signal. That was the first clue that the selling had stopped and the bulls were stepping in. Or as in many cases, we have a bullish signal, like a bullish engulfing signal, nothing really convincing until another signal, inverted hammer, gap up through the T-line. It's the combination that this one may not work solitarily on its own, but it confirmed the bullish engulfing signal a few days prior. Or if you want to give a signal multiple descriptions. For example, an inverted hammer doji followed by a bullish engulfing signal. So essentially you have a left-right combination with that first inclination that the bulls are stepping in because of that upper shadow. Close right on the T-line. What do we want to see next? We want to see them open positive. The bigger they, or the higher they open it, the more positive it is, starting a strong uptrend. An inverted hammer tells us the bulls have stepped in. Positive confirmation the next day. Morning stars type signal. Just more elements to the analysis that the bulls are now taking control. All right, let's take a look at the inverted hammer in a quick review here. The inverted hammer could be a gravestone doji or a bullish engulfing signal, but the main criteria is the tail to the upside tells the bears the bulls are coming back into this market. Even though they fade at the end of the day, the bears have witnessed the bulls trying to step into the market. When they add or come positive the next day again, the bears see that and they say, I want to get out of the way. So that inverted hammer is probably kind of a prelude to be watching for a positive open the next day, because if they do open a positive, the probabilities are probably 90-95% or greater that you're going to be in an uptrend. And the inverted hammer also is a definite piece of information telling you that the buyers are starting to come in, and then really confirmed when they gap it up the next day, telling you the downtrend has stopped. Now start looking for the bulls to step back in. Where do most people sell? They panic sell at the bottom. Anytime you see a gap down in an oversold area, start watching for a buy signal. Inverted hammer buy signal, start looking for a positive open the next day. This is not rocket science, just common sense application of investor sentiment in a graphic depiction. The bigger the tail or the bigger the confirmation after the inverted hammer, the higher the probability there's been a change of investor sentiment. That brings us to the conclusion of our training on an inverted hammer signal. I hope the repetition has helped you or helped your eyes identify the signal itself, and that you can recognize the other indicators that will improve the probabilities of being in the right trade at the right time. Very simple stop loss for a candlestick inverted hammer signal. If it opens positive, the probabilities are so great that it should be moving positive from that level, that it should not trade back down through the head of the inverted hammer. That'll be it. Hope to see you in the chat rooms. Thank you for listening.